we talked about operating budget, and we said that operating budget essentially does what? Covers 1 year of our operations, and we will go, let's say a capital budget, operating budget in Chapter 8, covers 1 year of our operations, and we're basically seeing what our cash receipts are going to be, our cash disbursements are going to be, and that's how we generate our cash budget, and we come up with our budgeted financial statements. And we probably do that for each quarter, if not on a monthly basis, okay? But often companies are going to be making decisions that are going to extend, obviously, beyond just 1 year. And so when we make decisions that extend beyond just 1 year, we call that capital budgeting. And when we're dealing with capital budgeting, we're going to be seeing that we're going to have to compare cash flows from different periods. So we may have an initial investment that we're purchasing, say, a capital item like equipment, and obviously that equipment is not going to just be used for 1 year. It's going to be used for several years. So there'll be an initial investment today with cash flows that will be going out into the future. If that's the case, in order to compare apples to apples, we're going to have to discount those future cash flows to their present value so we can compare amounts that we're going to spend now versus amounts that are going to be spent later, or maybe more importantly, amounts that we are going to be taking in revenue in later years. So we're going to have to be using present value tables as we go through this decision, and through these discussions. As I say that, I realize I forgot to open up my present value table, so I'll have to do that too. Present value tables are sitting on iLearn. You have those on iLearn. I put them next to the Chapter 13 slides, and I'll be putting them up on the screen here once I open them up a little bit later when we need to use them, and I'll show you how to use those present value tables. And you will need to use those on the exam. You're going to see that they are attached to the mock exam. If you didn't print it because it wasn't attached before, I'll give you a page that has that, okay? Okay, so let's go ahead and let's take a look at these capital budgeting decisions. Okay, and again, these are when we're dealing with long-term type things, not just a current year. We're talking about purchasing equipment. We're talking about replacing equipment. We're talking about should we lease or buy equipment or a building. We're talking about our plant expansion. We're talking about making an investment for cost reduction purposes. We're going to buy a newer machine that will be more efficient and reduce our operating costs. Maybe we're going to use hybrid vehicles instead of regular gas vehicles to reduce costs, whatever. And we need to think about these investment decisions both from the standpoint of cash outflows, but also the cash inflows, either through a cost reduction or increased revenue. Okay? Now, when we do these things, we basically are trying to think about two potential possibilities. One are screening decisions. So sometimes we'll say, I think I will. If I can't straighten back up, you got to help me up, okay? So what happens? We talk about screening decisions, and we'll say we will only take an investment if it meets certain criteria. If it doesn't, we're not going to take that investment. That's a screening decision. Sometimes we are looking at the preference between two different decisions or 3 or 4 different decisions. Should we go choice A or choice B? And using these tools that we're going to talk about will help us to make those sort of decisions. Okay? Now, when we get into the tools that we're looking at, we are looking at 3 in this class. We're looking at the payback method. We're looking at net present value method. We're looking at internal rate of return. Internal rate of return and net present value use time value of money, present value calculations. Payback method does not. Again, because we're going to be looking at these, I'll talk about present value in a minute. When we talk about our cash flows, we talk about cash outflows versus cash inflows. Cash outflows obviously include what? The initial investment. How much are we going to spend on this investment at the very beginning? Also, we'll probably have to maintain this piece of equipment, so we'll look at repairs and maintenance. We'll look at incremental operating costs. Maybe because we get this new asset now, we're going to have a little bit more in our operating costs. We're going to have to pay more for electricity or something like that. That would be a cash outflow. And then we will look at a tie-up of working capital. What does that mean? With working capital tie-up, that means that we are sitting there and we're going to have to put an initial down payment or something. For example, we're going to lease a piece of equipment, but the guy tells us that we got to give him $10,000, and he's going to hold that $10,000 until what? Until we return his equipment back to him. And it's sort of like a deposit. It is a deposit that he makes us put down so that we don't tear up the equipment or something, right? So we know we got that cash vested. That would be a tie-up of working capital. Now, that working capital one is something that students have trouble with sometimes because they forget in some of the problems to do what? If the working capital is tied up at the beginning, what happens to it at the end? It gets released, good, at the end of the project, right? So sometimes students will come to me during the test and they'll say, I can't get any of the choices. Is there a typo on this problem? And I'm like, no, there's not a typo. And I'll point to the working capital. Did you release the work? Oh, that's right. I have to release the working capital at the end, right? Okay. Now, we have other cash inflows, which is what? The incremental revenues. Obviously, if we're doing this project, it's because we think that we're going to get more revenues, right, out of this. Otherwise, we'd be foolish to invest in a project that's not going to bring in more revenue. We will also have as an inflow the salvage value if we're going to sell this equipment at the end. So at the end of the project, we can sell the equipment for $10,000. Well, that's cash coming back in, isn't it? Okay, and then we will potentially have cost reduction. You buy a newer, more efficient, more energy efficient machines, that sort of thing, right? I talked last time how companies are starting to realize, no matter who Trump appoints to the EPA, right, that what companies are starting to realize, wait a minute, even though we have to live within environmental protection laws, by legislation, by regulation, it actually improves the efficiency of our company, and a lot of companies are starting to realize, wait a minute, there's benefit in going green, etc., right? So maybe we invest in more energy efficient items that will give us a cost reduction. But all of these are cash inflows. Okay? Now, when we compare these cash inflows and cash outflows, we have to worry about the time value of money. Time value of money says this: an amount that I am going to receive in the future is worth less to me today. Think about it. You go ahead and I say, hey, can I borrow $1 million?
I'd say yes.
Huh? No, go ahead. Say no.
No.
Yeah, of course. You don't want me to borrow $1 million because what? I'm going to take it from you, then you're not going to have it, right? So I say, I'll tell you what. Why don't you just let me borrow $800,000 and I'll give you $1 million back at the end of the year? Are you willing to do that? All of a sudden it's like, yeah, sure. So what happens? That $1 million today is only worth $800,000, isn't it? Whereas in the future it's got a bigger amount. So our present values are always going to be what? Less than the future amount that we're going to pay out. We'll see how these tables work and help us calculate that. Okay, so that's called present value accounting. We have to consider the time value of money. And so for these cash flows that go into future years, we will have to discount these cash flows. Okay, and the process is pretty easy once you get used to it. Okay, now having said that, one of the first method that we're going to talk about, the payback method, does not consider the time value of money. It does not consider it. We just want to see how long is it going to take us to recoup our investment. Okay, so we go ahead and we take a look at the payback period. And it's the length of time that it'll take us to recoup our investment. And this will help us to determine if we want to do this project or not. So it's very simple. We will take the initial investment required. We'll divide that by what? By the annual cash flows that are going to come from it, and that's going to tell us how long it's going to take us to recoup the investment. Okay? So you just look at this example. We have a cost of a project, $140,000. Now they give us the life on this, but it is not really relevant to the payback method. But we're using these same facts for net present value method, then we would want to consider how long the project is. Okay. Now we're going to generate $35,000 per year net cash inflows, and they want to see what the payback method is of this espresso bar, whatever. Okay. So we take this 140,000, we divide it by the net cash flows that are going to come in each year, and it turns out that it would take this company what? 4 years to recoup the investment. If you're waiting for deeper meaning, stop, because there is none. That's it. They're simply telling us what? 4 years to recoup your investment. Okay. Now, if the company had said, well, look, we are not going to make any investment unless we can recoup our investment in 5 years, then they would accept this investment, right? What happens if the company's policy was that they have to recoup their investment in, I think you know where I'm going with this, 3 years? Then what? They would reject this because the payback period is longer than the threshold they'd set up for them, right? Okay. Now, there are significant limitations to the payback method. The biggest one being that it ignores the time value of money. So it is a very rough way of analyzing an investment, analyzing or making a decision. Very rough. Very rough, okay? I would not use this, frankly, for any business purpose unless I'm just sitting at a bar chatting it up with some potential, business partners, and we're just initially getting started on talking about something, right? But the true analysis would have to use present value accounting. Okay. The only time I've seen this really used at all for a quote-unquote business decision is I've seen it talked about, and a lot of people use this if you're refinancing your house and you have to pay certain charges to refinance the house. The rule of thumb that they use is whatever your payments will be, savings in your payments will be, it shouldn't take you longer than 2 years to recover any cost for the refinancing by the savings of your monthly payments. If it takes you longer than 2 years to recover those upfront costs of the refinancing, they often tell you don't do it. Okay. But that's very rough. Even for that purposes, I'm not sure that it's the best analysis. But I have seen that being a commonly accepted way of analyzing that transaction. Other than that, we're going to use present value. Okay. The beauty of payback is it's easy. So that's good for you, because if I give you one of those questions, it's going to be easy for you to answer that on the exam, right? Okay. Okay, good. Now, payback can get a little bit more interesting if we're in a situation where the cash flows are uneven. In that other one, we were saying the cash flows were whatever, $4,000 a year, whatever it was. I forget now what it was a year. So it was very easy to divide the initial investment by those even cash flows, right? What if the cash flows are uneven the way this is? Now, how would you handle that? Well, let's say, do they give me an initial investment? I thought one of these slides had an initial investment. Yeah, let's say that we have an initial investment of $4,000, and we want to see how long it's going to take us to recover that. Well, if you had a situation like this, you'd have to do what? Well, year one, we recovered what? $1,000. So that leaves us $3,000 that we have left to recover. Have we recovered our investment yet? Okay, we go to year two. In year two, how much do we get? 0. So we're now all the way into year 3, and we haven't recovered the investment yet. What happens in year 3? We get another 2,000. So when we get that 2,000 in year 3, we get into year 4, and we still have 1,000 that we have to collect, don't we? Okay, so when you get into year 4 and you still got 1,000 to collect, and then what? You finally collect that 1,000 in this example in year 4. So I guess by, and I don't know exactly when in year 4 they finally hit that collection of 1,000, but it's not until we're some point into year 4 that we recover our investment, right? So if the company thought that they shouldn't accept an investment unless it will pay back in 3 years, we would reject this, wouldn't we? If the company's policy was 5 years, we're all in on this, right? Okay. Okay, good. I know it's hard to concentrate if you're thinking that, you want your football team to win the game or something, but this is not text time. This is not Raider time. This is Accounting 101 time, your last chance before your final to understand something about what you're trying to get a B in. Okay, so let's keep the eye on the prize here, okay? The Raiders won't send a check to your house if they win, okay? All right, so let's go ahead and let's take a look at a couple of questions here using the payback method, and it's pretty easy, but they do bring out a nice point here actually that we don't see on the slides. And so we're saying that this company has an investment, and it's what, 8-year life on the investment, and it's going to require $300,000 up front with no salvage value. So we know that our numerator is going to be $300,000 because that's the initial investment. And now we want to see what our annual cash flows are going to be on it. Now what's interesting about this problem is they give me the operating income. They don't call out the cash flows, right? Operating income is an accrual number, isn't it? And that accrual number includes depreciation expense. Does depreciation expense use cash? It does not use cash. So what do? I take the operating income and then I have to do what? Add back the depreciation expense. Now I have the cash flow that's being generated from this investment after I consider my operating income and add back the depreciation, right? Hello? Right? Contribution margin minus my fixed expenses, but then they tell me, hey, some of that is depreciation. If I want to get cash flows off of this investment, I have to do what? What the cash flows are off of this investment, I have to add back the depreciation, don't I? Now I have the cash flows. Okay, so I'm turning this income number to a cash number, and when I get the cash flows, I go ahead and I divide the initial investment by those annual cash flows, net cash flows, and that gives me what, 2 years? Okay, it's just that simple. That's it. Question? Okay, good. Let's go ahead then and let's take a look at this one. And they tell us to ignore income taxes in these problems. And yes, we will not think about income taxes in Accounting 101. If I'm teaching Accounting 305, I would absolutely make my students, my accounting students, consider the taxes, because you have to have an after-tax cash flow to do this correctly. You got to pay your taxes, don't you? Okay, but we're not going to do that in this class, but you should be aware of that, to do this properly, we would consider the tax effects. But anyway, we have this Buy Right Pharmacy has purchased a small auto for delivering prescriptions. The auto was purchased for $28,000 and will have a 6-year useful life and salvage value of $4,000. Delivering prescriptions has never been done before, and it should increase gross revenue by $32,000. That's a cash inflow that's coming from this thing, isn't it? Okay, cash inflow of $32,000 that's coming. And then they say the cost of the prescriptions is $25,000. So I'm going to have a net cash inflow coming in on this thing, if I'm doing my math right, of what, 7,000? Peek over here, 7,000. Okay. Now I initially spend this 28,000. So if I take the 28,000 and divide it by the $7,000 a year, that's, even I can do in my head, that's what? 4 years to recoup the investment? Right? Okay. Okay, so pretty easy, right? Payback method. And that's about the only thing that I have good to say about it, is it's easy in terms of being a true analysis tool. Forget about it, okay? But something to be aware of, okay? More appropriately used is going to be the net present value method. Net present value method does what? It sits here and it says that we're going to consider the time value of money. We're going to sit here and we're going to discount future cash flows in order to be able to compare them to the current, and it's usually an outflow that we're going to be making for the initial investment. Okay, so we just can't compare, apples to oranges. We have to turn everything to, however you want to look at it, apples, I guess, to apples. Okay, so we come over and we take a look, and we'll look at the cash flows, both inflows and outflows, just like we did for the payback method. But now we're going to be using present value accounting to discount the cash flows. So let's just take a look. And when we're using the net present value method, we will accept a project if it has a net present value of 0 or a positive net present value. If its net present value is 0 or positive, we'll accept it. If the net present value is negative, we will reject that project. That's telling us that we're not getting the rate of return that we're expecting from this project if we get a negative net present value. If we get 0 or greater than 0, that's telling us that we're getting our what? If it's 0, that means we're exactly getting our required rate of return. And if it's more than 0, we're doing even better than our required rate of return. So this is a good way to screen a project. I'm sitting here. I have a pile of money that I want to invest. I'm trying to decide which projects I want to invest in, and I only take those that have a positive net present value. Now, we'll get into this later, but you could also use this as a ranking tool, not just a screening tool, but a preference tool. What happens? Pile of money, bunch of investments that I want to make, and I'm going to do what? I'm going to take the one with the highest net present value first, and then work my way down the list going in inverse order down to those with lower net present values until I'm out of money to invest, right? So it's not only a screening project tool, but it is also what? A way of deciding against the different preferences tool as well. Okay, so let's just go ahead and let's take a look at this example where we'll use the net present value method, and we have this cost of this equipment, $160,000. That's the initial amount going out. We have a tie-up of working capital at the very beginning. That's $100,000 going out. In 3 years, and this is where we start getting into, we're now going to be comparing cash flows from different periods. 3 years from now, we're going to have to reline the equipment. So we're going to have some repairs and maintenance that we're going to have to make in 3 years. What else? We will be able to sell the equipment at the end of the project in 5 years for a salvage value of $5,000. So that's an amount that's going to be coming in, but it is what? Several years down the road, isn't it? Okay, so we're going to have to use present value accounting for this. Then what? On an annual basis, we'll have sales revenue of $750,000. The cost of the parts sold will be $400,000. We have to pay salaries and shipping, so we're going to have to calculate a net cash inflow from this investment, right? And all of this is going to have to use present value accounting in order for us to figure out whether or not we should do this investment to see if it has a positive net present value. So I go ahead and they tell me that the company's expected rate of return is 11%. That's sort of what they say is their hurdle. We're not going to take a project unless it gives us a return of 11%, and we'll know that it gives us a return of 11% or better if the net present value is either 0 or greater than 0. If it's less than 0, that by definition means that we are not getting that rate of return of 11% at some amount less. So we want to try to get something with a positive net present value to help us get an 11% return. So we come over and we first calculate the net cash inflows, and so we have this initial investment of $750,000. We have the cost of the parts sold, just taking that information from that previous slides, and we have salaries of $270,000 in the shipping. So we have net cash inflows of what? $80,000 a year on this project for, what was it, 5-year project? Okay. Then what? Then we sit there and we start to do our present value calculations. Now, the $160,000 initial investment has a present value factor of 1 because what? $160,000 that we're paying out today is equal to $160,000, right? The tie-up of the working capital that happens today now is what? Present value of $100,000. The amount that you're paying today is that amount, right? So we don't have to do any real calculations there. Now, we take that $80,000 net cash inflow, and because that's going to come out over the period of the next 5 years, we need to get a present value of that. So we need to sit here and go to a table that will give us this factor, and we go to the present value of the annuity factor for 5 years at 11%, and we see that factor in there. We multiply that by the 80,000, and that gives us the present value of those future cash flows of 80,000. If it's 80,000 times 5, that's what? 400,000? But notice the present value is less than 400,000 because amounts in the future are worth less than amounts today, aren't they? Or I should say the other way around. The amount today is worth less than amounts in the future because we're going to have to wait for that money, right? So we pick up that present value factor from the present value of the annuity table. Now, how do we use that table? And I'm going to go ahead and try to find that file without having too much of a disruption here. Let's see if I can find it quickly. That's a dream that I'm going to find it quickly. Let's see. Present value tables. Well, that didn't take too long. Don't say anything, John. It hasn't opened yet. Okay. I'll give you the tables. I even have the tables in the in this mock exam that we're going to use, so you'll see it'll be something like that. Okay. In fact, well, I'll have the tables for you for sure. I'll either have the tables or I'll have the present value factors embedded in the individual questions, one or the other. Okay. But you're going to need to know which ones to use. I won't give you the exact ones. So let's just take a look at this, and we have these present value tables. Okay, and these were on iLearn. Okay, but we have these present value tables, and this one is present value of $1. Present value of $1 is the table that we use if we just have a one-time payment. Just a one-time payment, and we're trying to get the present value of that. We use present value of $1 table. That one that we were looking at was not a one-time payment. It was what? 80,000, 80,000, 80,000, 80,000, 80,000. It was 5 of them, wasn't it? So we can't use this table, right? We have to go to a table that is for multiple payments, and the table that is for multiple payments is called present value of an annuity. Present value of an annuity. Present value of an annuity. If you buy a lottery ticket tonight, if they're for sale tonight, whatever, I don't know. I don't play the lottery. What's the odds of winning the lottery? 49 million to 1. Okay, so take the number 1 and divide it by, there's 49 million different combinations of numbers that they can come up with those numbers that are on the lottery ticket. So take the number 1 and divide it by 49 million. See what number shows up on your calculator screen? That's your odds of winning. Okay, which is 0. Okay, so what happens? I don't buy the lottery ticket for that reason. That's kind of like saying, maybe I'll get killed by lightning tonight. Nobody walks around thinking that's going to happen, but the chances that that's going to happen are greater than winning the lottery. Yet everyone buys a lottery ticket. Okay, anyway, so what happens? What was I talking about? Annuity. Thank you. You buy the what? Someone's got to keep me straight, right? What happens? You sit there and you buy a lottery ticket, and you're hoping that what? You win, and then they're going to pay you out an annuity over what? Over the next, 20 years, whatever. They'll pay you $500,000 a year, something stupid like that. I don't know, whatever it comes out to in these jackpot winnings, right? So that's an annuity, isn't it? When amounts come out over a certain period of time on a regular basis. And for this class, we just assume everything's going to be an annual payment that's going to come in, those 80,000s, okay? So we found the right table, didn't we? Because that's a stream of payments, an annuity. And they told us in the problem that the interest rate was what? That they were looking for? 11% was the interest rate we were looking for. Good. Right there. Oh, that's irritating. Okay. When I touch it with my finger, then it went ahead and printed. Okay, went ahead and wrote. Okay, so it's 11%, right? And then what? I'm sitting here, and how many periods was the project? 5 periods with the project, so I'm right here. 3.69590. Was that the number that they used in the example? Pretty close. They rounded, didn't they? We didn't round in ours. That's all right. Please, let's not get into a rounding discussion, guys. There will be no choices that, you'll have to sit there and decide because there's a couple rounding differences, right? Okay? Okay, good. So is that the factor they picked up? 11%, 5 periods. They multiplied that times these annual payments, net cash inflows of 80,000, right? Okay? Okay, good. Then we come over and we take a look at that. And remember, when they relined the equipment, and I'm staying out of the slideshow mode because I want to get back to that table. When they reline the equipment, it is what? It is a one-time payment, isn't it? Of 30,000. You'll have to do that relining one time. So when I go over back to the analysis here, the present value analysis, there's my annuity amounts for my 80,000 annual cash inflows. There's that one-time payment that's coming out, but I don't use an annuity because what? It is a one-time payment, isn't it? So I go over to my tables. Can I use this table? I have to go over to the present value of the dollar table. And when I come to the present value of the dollar table now am I on the right table? I'm going to use what? 11%, 5 years is what? 0.59345? Is that pretty much the number they used? Oh, that's why it didn't sound right. So it's 0.731. Thank you. So I come over and it's what? 3 years. So I have to come up here. Not that one, but this one. 0.73119. Okay. And so I come over and I look back, and that's pretty much the number they use, except they round it, right? So now I got the present value of that one-time payment for the realignment of the equipment, right? Okay. Okay, good. Now I come over. This realignment of the equipment only happens once. This 80,000 is going to come in. That's our annual net cash inflows. So we'll get 80,000 in year 1, 80,000 in year 2, year 3, year 4, year 5, whereas the 30,000 only comes out in year 3. Okay, so for the present value of the annuity, we came over and we had to use present value of the annuity table because what? Because it's more than one payment. And this table contemplates more than one payment, doesn't it? Okay. How do I know if I'm on the annuity table, other than the fact that it says annuity on top of it? But how would I know just by looking at those numbers? Yeah, if in fact they're bigger in a certain way. Every single number on this table is bigger than 1 because I have what? More than one payment, don't I? Except for what? The one payment row, which has numbers less than 1. And I'm of the opinion that Trump should pass a law that all tables, all present value of annuity tables, should take that one payment row off of it. Isn't that what Trump should do? Because it doesn't make any sense. Why have a one payment row on an annuity table when annuity means it's more than one payment, isn't it? So they really should get rid of that row. And then what? Then all payments would be more than one. Numbers I should say would be more than 1, wouldn't they? And they should be because the payments are more than 1. Now you sit here and you say, but John, if it's 5 years, why aren't these numbers 5? They're not 5. None of them are because what? We know that the present value is going to be less than that future value, so we got to get it less than 5, don't we? Okay, so that's how you know that you're on the right tables if you got numbers that are pretty much bigger than 1, except that first row, which in my opinion doesn't belong there. Okay? Okay, good. So we go through. Does that answer your question? Yeah, okay. So we go through and we take a look here and we go ahead and we get the present value of that one-time payment, picking that up from the present value of the dollar table, right? Then we come over and we take a look at the salvage value that's going to come back. And I know, guys, it gets hard to remember where some of these numbers were coming from. But remember they said we were going to what? Salvage the equipment in 5 years. And when you salvage the equipment, you what? You only pay that once, right? You can only sell a piece of equipment once. So we go to present value of $1. And now that is going to be what? That is going to be 5 years when I look at the table. And then we have this release of the working capital that'll come at the end. Remember, guys, I told you that's the one thing that you'll probably forget is to release the working capital at the end of the project. So you take a look, and that's what they did here. They picked up the present value factor for the scrap and the release of the working capital at the end of the project, right? And that's that 0.593. Those are both one-time occurrences. So we go to the present value of the dollar table, and I think I had already circled that number by accident, right? For the 5 years, right? There's that number 0.59345, whatever. Okay, and again, on here, they went ahead and they rounded the number. That's fine. Okay? Yes?
Okay, so the 0.731 came one-time payment.
Yeah.
You paid it in the year 4?
Paid in year 3.
3.
Year 3.
Oh, okay.
We had to realign the equipment in year 3, so we went to the 3-year row on there, and then for the other two, they were also one-time payments, but they came in year 5, so we had to go to the 5-year row. We were still in the 11% column, though, right? Okay. Okay. Well, that's pretty easy, right? Okay, and so what happens when we take our what? Our cash outflows. Usually, guys, cash outflows are going to happen, the big ones, up front at the beginning of the project, right, when we're making that initial investment. And then what? Then we're going to have our cash inflows coming later, and there might be one cash outflow later if we have some sort of repair or something that we have to make on this, okay? And we net all that out, and we end up with a positive net present value of $76,015. Do you want to do this project?
Yes.
You'll do this project because it has a, do you guys use the term hell of? Or is that a Hayward thing? It has a hell of net present value, doesn't it? Because what? It's like $76,015. And we would have taken what? We would have taken a project that had a 0 net present value. This one's pretty positive, right? Okay? Okay, good. Now we come over and we remind you then that if we have a positive net present value, we should accept the project. If we have a 0 net present value, we should accept the project. If we have a negative net present value, we will what? Likely reject the project. I mean, it's not like we automatically have to reject. You know, if it has a negative net present value of 1 cent, you know, then I'd say your rate of return is 11%. I'd say you're pretty close. Might as well go for it, right? But the further it gets away from being positive, the more likely we'll reject it. Okay? Question? All right, good. So with that, let me do this real quick. I'm going to put us back into slide mode. And for some reason, I realized the other day I started internal rate of return discussion, and then all of a sudden I had these net present value calculations in the middle of the problem, and for some unexplainable reason. And so I'll come back to the internal rate of return. Let's just try some problems using net present value. Okay, so I'm just jumping ahead to some of the questions with that. And so we have this initial investment of $360,000. Annual net cash inflows of $118,000, 4-year life on the project. Discount rate is 12%. Okay. Now the way I like to do these is I put amounts that I'm going to pay now versus amounts that are going to be coming in or being paid in the future. And then in between them, I put a what? Present value factor. Okay, this is the way I set these up. Amounts that are going to go in the future versus now. And then I put a present value factor. So I have a payment that's going to come out now, which is what? This initial investment of $360,000. I know is what? Is coming out now, isn't it? $360,000. Then I have this $118,000 that is going to be coming in the future, isn't it? But I need a present value factor, don't I? Now, is this an annuity or is this a one-time payment? This is an annuity because it's going to be per year. So I go over to my table, and before I jump over there, it's what, 12% for 4 years? Okay, I want to keep that so I don't lose that writing. And I'm going to go over to my table, present value of annuity. Huh? Is that the table I want? I need present value of an annuity, so I come over and I'm going to look for the factor that is going to be what, 11%? 12%? Whew, barely made it onto this table. Okay, 12% for how many years? 4 years. So the factor 1, 2, 3, 4 I'm looking for is 3.0375. Okay, 3.0375. Somebody remember that number? 3.0375. I come back, I take that 118,000, I multiply it times 3.0375. Did I pick up the right number? Okay. I multiply that 118,000 by 3.0375 and I get how much? 358,425, I think I heard. Okay, so 328,425 is the cash inflow versus on a present value basis, right? Versus on a present value basis, the amount I'm going to pay now, the 360, right? Right? Okay, and so I end up with a net present value of how much? I don't think it's exactly 1516. What is it? 1,575 thereabouts. Okay. So, but obviously what? Obviously the right answer is given here, right? We find that that's the right answer. Now, why is there a difference? Because the textbook used rounded figures instead of the ones that we drew out for longer decimals. Okay. The other thing that the book did, although that's not the reason for the reason for the difference is the rounding. The other thing that the book did is they discounted the cash flows one payment at a time. So they went up and picked up the present value of a dollar factor for 1 year, 2 years, 3 years, 4 years, and then multiplied each one of them out individually. And I'm saying that somebody that does that has a fetish for multiplying because there's no reason to do that when you can sit there and what? Just do a one-time multiplication by using the present value. That's why God created that table, so that we could sit here and do what? Just make one calculation, right? I mean, what if it was 50 years? This guy would be here for the rest of his life trying to get these calculations right and then adding them all up, etc., right? Right? Can you think of a circumstance where you would have to do this? Do the cash flows one at a time, even though they came out over a period of time. If the cash flows were uneven, you'd be stuck with this, wouldn't you? You'd have to sit here and do each one of them one at a time. The beauty of that is that God also created something called Excel. And with Excel, you just simply do what? You just simply highlight the whole row of payments and you hit the function present value and it'll give it to you that way, right? Okay, but we're going to use the tables in here, obviously. We're not going to be doing Excel calculations. Okay, was there a question, sir? Okay. All right, question? Okay, good. Let's go ahead then and let's look at another one now. And this is another net present value calculation. This corporation is investing the purchase of a new threading machine that cost $18,000. The machine would save about $4,000 per year. The present value of the threading parts and components would have a over the present method, I should say, not present value. The machine would save about $4,000 per year over the present method of threading component parts and would have a salvage value of what? $3,000 in 6 years. Then the machine would be replaced. The required rate of return is 12%. We can still use that same table, right? Okay. And so what is the net present value closest to? So, again, the way I set these up, I talk about payments that are going to come out now versus payments that are going to come out what? later in the future. Okay, good. And I'm going to get a present value factor for these, aren't they? Right? Okay. Now I always say get a present value factor, but I don't bore us with, multiplying anything times 1. The amount that what comes out now for the cost of the threading machine is just 18,000, right? So I take that 18,000, that's coming out now, and then let's see again what's going to come in the future. The machine would save 4,000 per year. If it's 4,000 per year, is that a one-time payment or annuity? Good, that's an annuity, so I'm going to put that 4,000. I'm again going to get out of the slideshow so I can go back to the table. I want to keep that. I go back to the table, and I've got to get on the present value of the annuity table, right? And this time I'll change the color up a little bit so we can see it easily. Is 12% is the interest rate, and it was how many years? 6. So we're right here, 4.1141. 4.1141. Okay, so I go ahead and I pick that number up, and I'm going to go back into the slideshow for this particular one, current slide, and I'm going to pick up that number 4,000 times 4.1141, was it? 411? 41, thank you. 4,000 times 4.1141 is what? 16,445, you say? And 64 cents? Okay. Okay, good. Then what? Keep reading, and the machine has a salvage value of 3,000 in 6 years, doesn't it? Is that going to be an annuity or one time? That's one time, so 3,000 times, once again, go back to the tables. Which table do you want me to go to? Present value of $1, right? Not this one, but this one up here. Present value of $1. Where are you? Come up. 12%, right? And it was what, 6 years again? Oh, no, how many years was that? That was, because it's a salvage value. That's right, because it's a salvage value. So that's at the end of the project. So that's 0.50663. Okay. Did I pick up the right one? Yeah, 0.50663. So we multiply that times 0.05633, and we get what? We get, huh? Oh, 0.5? 0.50663? 663, like that? Okay, so I multiply that, and that gives me now this, what, 1519 that's going to come in at the end of this, right? Okay, good. So I go ahead and I have the negative initial amount that's going to have to come out, and I add in the amounts that are going to come in, and that gives me negative, what, 34.47? Okay, so that's pretty close. Again, they use a rounded version of the table that's more rounded than the one that we're using here, so that's why we have a little slightly different numbers. But clearly that's the right answer, right? Would you do this project? Okay, maybe not, but I think management's getting a little greedy, to turn this down because, well, it's $34 negative present value. Meanwhile, you're getting a 12% return. Okay, that's not that bad. Now, if you got, 10 other projects that you want to try first that are giving you a 20% return, then okay. But this is all you got. You're not going to reject it just because it's a few bucks off from having a return of 12%, right? Okay, so again, the closer you get to 0, the better. Okay, but you'd like it 0, and you'd like it positive because that means an even greater return. Okay, good. So I'm not going to do this one because we're going to practice with some of these in the mock midterm. So you're going to get some more practice with these here in a little while. So no sense in beating a compliant horse. Let's go ahead and let's look at internal rate of return. So I'm going back a little bit because, again, I stuck the questions in the wrong place. I put some questions after the discussion of inherent internal rate of return when I don't have to. Okay, guys, this is not the time to be flirting. This is the time to be paying attention to this up here. Flirt after class. It'll be much more enjoyable because you'll actually know that you're going to get a good grade on the test. Okay, all right, so let's go ahead and let's take a look at the internal rate of return. An internal rate of return is that rate of return that will cause the net present value of the project to be zero. In other words, what? Net present value of a project will be zero when the present value of the cash inflows are equal to the present value of the cash outflows. Won't that make the net present value zero? Okay, so whatever that interest rate is, we call that our internal rate of return. Now what happens? We will set up a hurdle rate, a minimum rate of return, and if our internal rate of return is equal to or greater than that hurdle rate, then we will accept the project. If the internal rate of return is less than that hurdle rate, we will do what? Reject the project. And think about it, makes sense. Hurdle rate is 11%, internal rate of return is 10%. Did we hurdle it? No, we tripped over it, didn't we? Okay, and so what? We'd reject that project. Our hurdle rate is 12%, internal rate of return is 13%. We would accept that project, right? Okay, now how will we come up with the internal rate of return? Okay, I just want to go and look at this example where we have this machine. I don't know what this is, smog machine, whatever it is. And we're sitting here saying, okay, the machine will cost us $104,320. It's going to save us $20,000 per year, and the machine is going to have a 10-year life. Okay, so we come over and we want to figure out what the internal rate of return is on this. Now, they set this up here where they show you how to come up with the present value factor by taking the investment required and dividing it by the annual cash flows. Okay, but I'm going to do this a little bit different. We know that the present value of the annual cash flows I don't want to put present value next to it, though. Let me do it this way. So it makes more sense. We know that we have to take the annual cash flows, right? And we have to do what? We have to sit there and multiply that times the present value factor. And if that equals the initial investment, then by definition, what? The present value of my annual cash flows are equaling my initial investment. Thus, my net present value is zero, isn't it? My net present value is zero if what? The present value of my future cash flows equal what? Equal my, the present value of my future cash flows, positive cash flows equal my initial investment, which is negative, right? If that's the case, the net present value is zero, isn't it? Right? Present value of the future cash flows equal my initial investment. Net present value is zero. So I've set this thing up to make the net present value zero, haven't I? Then I simply go ahead and I do what? Divide each side by my annual cash flows, guys. I'm not going to rewrite what's already here. If I divide each side by the annual cash flows, then I'm left on one side with what? Just the present value factor, and I have on the other side the investment required divided by the annual cash flows, don't I? right? So now I have the present value. I have the present value factor that will make my cash flows equal to my initial investment to make my net present value 0, don't I? So now I'm going. What's the matter? Did I hear pain? Did I hear a cry for help? Okay, do you understand that my annual cash flows times my present value factor has to equal my initial investment for my net present value to be 0?
Yes.
Okay, we're there? Okay, good. Then we're a long way towards your understanding this. We're right there. Okay, because what happens? Then all I did, tell me again, Felicity. Felicity, then all I did at that point was I just did the algebra. I simply divided each side by the annual cash flows. If I divide each side by the annual cash flows, that'd probably be easier if I just, maybe I should, right? If I divide each side by the annual cash flows, I'm just going to write it, but it's going to be kind of silly after I do it. Then it's going to be initial investment divided by annual cash flows is going to be present value factor on this side, right? Which is this right here. I mean, that's just the same thing, right? I just did the algebra. I divide each side by the annual cash flows, and I'm left with present value factor on this side, initial investment on this side, right? Okay, and in this example now, just going back, it's $104,320 is the cost of machine. Annual cash flows are $20,000. When they divided it, they got the present value factor, didn't they? So I've got the present value factor now, right? With me so far? Okay. Now what they're going to do is they're going to use the table backwards. They're going to go to the present value of the annuity table. They're going to go to the present value of the annuity table, and they're going to do what? How many years was the project? 10 years? How many years was this project? 10 years? Okay, so they're going to go ahead and they're going to go to the present value of the annuity table. They're going to come down to the 10-year row, and they're going to run their finger along this thing until they find that present value factor. And of course, what's going to happen is this the table that doesn't have it? Yeah, this doesn't have it. Okay, so what was the number I was looking for? 5 point what? 216. Yeah, so I have to go to the other table. And I can't tell you who decides that a table should stop at 12%. I don't know. I don't know. Again, if Trump, wants to help the world, he should make the tables have all percentages be 1, 2, 3, all the way up to 50%. So we don't have to look for another table that has the number we're looking for. But whatever. I had to go to another table because it wasn't on this stupid one. Present value of, is this the right table? Huh? That's present value of $1, and I know because all the numbers are what? Less than 1. So I come over here. Here we go. How many periods was it? 10 periods, and I'm looking for what? 5.216. There it is, thank God. And look, in the classroom, there's always the factor exactly, okay? In real life, you might have a difference between the factors, and you have to do something called interpolation, and I'm not going to get into that in this class. There will always be like, Dora the Explorer. What took you so long? And you'll finally get it, and it'll be perfect at the end, okay? So what happens? It's 14% is the return, right? And I know that by coming up the column. Okay, so I basically use the table backwards, don't I? Right? Okay. Okay, good. So when I do that, then I can answer this question, which is the internal rate of return for this project is what? 14%, isn't it? Okay, and they show me the same thing. They just did the same thing we did. They came to 14%. I just showed you on the table, but that's the internal rate of return. Now, if the company's hurdle rate is 12%, will they take this project? They'll take this project, right? If the company's hurdle rate is 15%, will they take this project? No. Yeah, we saw that already. Okay. I don't know why that's there again. All right, I'm not going to do this question. I want to do, let's do one from the book. Okay? Okay, good. So from the actual problems. And after this, guys, I'm going to turn you loose on these questions. Okay, we're going to take the break. Yeah, our timing is about right, I guess. Oh, it's a little longer than I thought. We'll take a quick break, about 10 minutes, and then I'm going to have you do the questions, till about 9. And then we're going to go through, and we're going to go through those questions together. Okay? Sound like a plan? Okay. All right. So let's go ahead and let's take a look at this. And they're telling us that we have the internal rate of return. We know that the internal rate of return is going to be the what? Annual cash flows times a present value factor is going to have to equal what? Our initial investment. Okay, and so our what? Our present value factor that we want to get is going to be equal to our initial investment divided by the annual cash flow, right? Okay, good. So do I have an annual cash flow here? Do I have an initial investment here? Going to have to purchase this truck, whatever, for $178,848. With me so far? Okay. And they tell me that the net cash flows are what? 36,000. I divide that. Just doing this formula right here now, right? It's not even a formula. It's just, logic here, really. And when I do that, I get this factor over here, 4.968. So I go ahead and I come over to the table, present value of annuity table, right? And I look for, I'm sorry, how many years was the project? 8 years. 8 years. Good. So I run my finger along the 8 years, and I'm looking what? 4.968. There it is. There it is. So my what? My internal rate of return is 12% on this. Okay. And so I come over and take a look, and that's, we had already seen that that's the correct answer. It's 12%, right? Question? Okay, good. Let's go ahead, guys. Let's take a 10-minute break. We're going to come back at 8:20. That's about perfect. We will spend 40 minutes doing the mock midterm, and then we will go through the mock midterm starting at 9 o'clock and probably take us up to the rest of the class to finish that, going through it, okay? Okay, guys, I'll see you in 10 minutes, okay?